The war in Ukraine is what I'm most concerned because of its long-term effect.
The brutal war in Ukraine is affecting the gas market in Europe. And what we have done over the last, I would say, 9 months is really looking for every well we can turn to increase the production.
So today we will propose to ban all Russian oil from Europe.
This is Bloomberg Surveillance, Early Edition with Francine Lacqua.
Well, good morning, everyone, and welcome to Bloomberg Surveillance Early Edition. I'm Francine Lacqua here in London, and here's what's coming up on today's program. The 75 basis point question: when the Fed says hike, traders ask how high and how fast. A new raft of sanctions. The EU proposes to phase out Russian oil by the end of the year. It also aims to cut off Sberbank and other lenders from SWIFT. And shifting goals. Russia looks to annex occupied Ukraine, narrowing its objectives for the invasion. So we have a big market day ahead of us. Of course, it's Fed Day. We've been waiting for this very moment. 50 basis point hike definitely now priced into a lot of these markets. But what happens next, and how hawkish will Fed Chair Jay Powell be in his press conference? You can see European stock 600 down 0.2%. Of course, bonds are falling a touch. If you look at futures in the U.S., they're pretty much a little changed at the moment. Again, investors really bracing from the messaging from the Fed, what they'll do with the balance sheet. I know that a 75 basis point hike is not something that market is pricing in, but could we be surprised? That's the unknown that I would look out for. And of course, the fact that Europe is moving towards an oil embargo, but in the next 6 months to Russia could have repercussions, not only on this crude oil, currently at 105.24, but some of the inflation expectations going forward to Europe that could also feed through the U.S. The U.S. 10-year yield currently 2.96, just shy of that 3% that we touched 2 days ago. And then you can see pretty much unchanged for these futures. So let's go straight to European map to, again, give us an indication of some of the earnings that we had out there. I spoke to the Pandora chief executive, Equinor, two stories that didn't do as badly as some were expecting, and so they're getting a lift. Equinor, the guidance going forward is not as strong as it could have been. So it's getting a little bit of a hit, but you can see the UK down 0.2%, the FTSE MIB over in Italy, similar losses. And then you have the DAX and the CAC unchanged, really trying to wade through what we're seeing overall when the Fed decides and what it does in terms of getting away from this accommodatary policy. And of course, how do you read inflation? If you're a trader and you're not used to inflation because we haven't had any for the last 15 years, how do you position ahead of the Fed? The other story we're watching out for is Lyft. This is one of the most interesting pre-market trade, and you can see down 26% as there are questions, of course, overall about the outlook for some of these companies as we get out of the pandemic. So out of the lockdowns, people use some of these services left. Lyft, their pre-market down a quarter of its overall value. Now, the European Union has proposed to ban Russian crude oil over the next 6 months and refined fuels by the end of the year. European Commission President Ursula von der Leyen addressed the European Parliament on the sanctions.
We will make sure that we phase out Russian oil in an orderly fashion, so in a way that allows us and our partners to secure alternative supply routes and at the same time be very careful that we minimize the impact on the global market. And this is why we will phase out Russian supply of crude oil within 6 months and refined products by the end of the year.
Let's get straight to our Europe correspondent, Maria Tadeo, with us in Germany. Maria, the million-dollar question is that it takes two to tango. The European Union can say, look, we're going to phase it out orderly, but will Putin agree with that?
Well, Putin, for starters, Francine, is going to take a big hit when it comes to the revenues that he could potentially lose from now until the end of the year. The head of the commission in that speech, she said this war in Ukraine is going to have a cost, and it will be a cost on Russia, and it will be a heavy price. But you're very right that this could have repercussions on the global oil market, and for the Europeans, it could also come with a hefty price. But I would say one thing, Francine, we have seen already, even before this embargo was announced, that the European Union has been cutting its reliance on Russia since the war started. When you look at a country like Germany, oil imports have dropped from 35% before the war to now 12%. So perhaps on that front, the impact could be moderated. The other issue, Francine, to keep in mind here is that, as you alluded to, going into the speech, von der Leyen made it clear that this is not going to happen from one day to another. It will be gradual from 6 to 8 months. Also, countries like Hungary will get a special regime, so they approve this and get on board with it. But for the Russians. I think the point now is, how are they going to respond? Will they threaten now to cut taps? We're also moving very close to that ruble payment deadline for gas in mid-May. So this move today could really spark retaliation from the Russians, but again, also reverberations on the global commodity market.
Yeah, I guess some of the other announcement, right, not only on SWIFT, but on potash. If you put sanctions on Belarus and potash, this means that inflation on food prices will accelerate significantly.
Yes, Francine, and this would come now from Belarus, but it's interesting now that the European Commission looks at Russia and Belarus as two countries that are essentially operating under Putin's guidance and, of course, are co-belligerent in the war in Ukraine. And now this could really accelerate that price inflation that European authorities have been warning now for weeks now. They also warned that for countries that already suffer from issues related to food prices, and, of course, countries particularly in the developing world, could see this accelerate even further and could lead to serious problems before the end of the year. The other issue, Francine, moving away from the commodity markets, is also has to do with the transportation, the brokerage, the insurance around a lot of these commodities, which the European Union says they also look to ban in tandem with the embargoes.
Maria, I just want to, quantify. I mean, these are proposals, right? I mean, I said there's basically sanction on Belarus and potash. Do we think that the European Union countries will be behind what the Commission proposed?
Well, look, Francine, if I have to be very frank with you, a day ago I would have said no. There was division. We saw it played out on Monday when energy ministers met in Brussels. But I think the key here is that the Commission and Ursula von der Leyen did not refer to this explicitly, but sources really are confirming this to us, that there will be carve out for countries like Hungary, but also Slovakia, countries that could have potentially blocked this. And they believe that the special treatment will get this new package through the finish line by the end of the week. So really there is a sense today in Brussels that this package is almost like a done deal and will happen before the end of the week.
Great. Thank you so much. Our reporter there on the ground in Messberg in Germany. Now, traders, of course, bracing for the Federal Reserve to raise rates by 50 basis points today, which would be the biggest hike since 2022 years. At the Milken Institute Global Conference, investors spoke to Bloomberg's Romain Bostic about U.S. inflation.
We don't think this is a lost decade of the 1970s. Just returns are going to be a lot lower, and we're going to have to work really hard for our clients to find those opportunities.
Multifamily in the United States is having an incredible run, and we're seeing double-digit rent growth almost across the country, and it's not letting up. And it's a big component of inflation, too, the cost of housing.
I think we're going to have wage inflation starting this summer. So I'm not going to say the word stagflation is a high risk. It's still a low risk, but it's got to be in the vocabulary for next year. And there's nothing you can invest in. There is no opportunity when you're in a stagflation environment.
Now we're joined by Bloomberg's markets editor Christina Keene and Freya Beamish, head of macro research at TS Lombard. Freya, what if the Fed were to actually surprise the markets with 75 basis points?
I mean, I think it would be another one of a series of hawkish shocks that's come out from the Fed since Q4. So we can't rule it out, but it could be that the Fed is about to get what it wants in essentially what is a game of chicken that it's playing with the rest of the world. The hawkish kind of rhetoric and the validation of hawkish market pricing since Q4 of last year. The nice way out of this from the Fed perspective, at least from the perspective of 2022, is if the ECB simply falls off the hawkish bandwagon and the PBOC already is capitulating with the renminbi moves that we've seen over the past few weeks. And essentially that brings down the import inflation and helps the Fed to kind of tamp down on inflation in a less aggressive way. But the other option being to kill equities.
So what does a policy mistake at the moment look like? Is it too aggressive or actually a Fed that's not aggressive enough?
I think there's a 2022 answer to that, and then there's a longer term answer to that. And if I can couch this in the much wider context, there is an asset cycle in the U.S., as my colleague Steve Blitz likes to say. Since the global financial crisis, there is not a credit cycle. There has been a credit cycle in China. And essentially what we see at the moment is the battle. You can couch it as a kind of a drama between tech and Chinese developers. And as the Fed tightens, it's likely, I think, probably that Chinese developers roll over first in the context of the recession that we're forecasting in China. And that actually helps the Fed out because it means that the dollar is doing some of its work for it rather than the Fed having to essentially end the asset cycle that has started since the global financial crisis. And that would be the hard landing for this year.
Yeah, the hard landing. So what's the likelihood actually that we get some kind of hard landing, and where do we end up with dollar in this scenario?
I think hard landing this year, our base case is that the growth scare becomes great enough in Eurasia, and potentially there's even a scare within the US, which we could talk about as well. And that's great enough to avoid the kind of the full hard landing this year. That's not to say that you now get a rally in equities. And I think to emphasize our longer term story for equities is that there has to be a re-rating of valuations over the next 3 years to almost as a result of the success of the US economy, which sounds like a strange thing, but the success of the US economy means higher interest rates, higher equity yields, and therefore lower valuations. So the hard landing has to come at some point over the next few years, but maybe it's postponed this year by the weakness in Eurasia, which brings the dollar into an even stronger position and does some of the Fed's work for it this year.
Freya, let me also bring in our Bloomberg Markets editor, Christina Aquino. Christina, I mean, the timing of the commission saying, look, they'll phase out Russian oil on Fed Day. Do we worry about inflation that, U.S. inflation will eventually hurt Europe much more than it does the U.S., also with that supply shock coming from China?
Absolutely, Francine. I think this really just plays into the anxieties of markets and investors when it comes to inflation, because we're not just looking at that supply shock, supply-driven, commodity-driven sort of inflation via the oil price. We're also looking at kind of more durable inflation when it comes to the price of goods and services. And so I think this all just kind of comes together, really emphasizes to both investors and policymakers themselves that this is a problem that is here to stay, it's not transitory, and they're going to have to do something about it.
Great, Christine. Thank you so much. Christina Aquino and Freya Beamish, head of macro research at TS Lombard, both stay with us. Coming up, Lyft shares plunge in pre-market after weaker than expected outlook. Uber brings forward its results announcement to before the bell today. So we'll talk ride-hailing, that sector, up next. And this is Bloomberg. Economics, finance, politics. This is Bloomberg Surveillance Early Edition. I'm Francine Lacqua here in London. Now, shares of Lyft plunged after a weaker than expected outlook. Investors concerned that a planned increase in spending on driver incentives by the ride-hailing company could actually weigh on profits. Meanwhile, rival Uber's shares recovered from more than 10% fall after it said it will bring forward the results announcements to before the bell today. So joining us now to talk about tech and to talk about some of these ride-hailing apps is Bloomberg Quick Takes Alex Webb. Alex, Lyft, so it actually beat expectations, revenue, EBITDA, net basis, but why such a negative share reaction?
Well, it is to do with that spending going forward, but it's also the way that they made money. They didn't do it from adding customers. They did it from charging the customers. Well, they added some customers, but it was a lot of it to do with higher pricing. And higher pricing is something that it actually in the long term can turn customers off. That people sit there and they go, well, actually, why am I spending all this more money on ride hailing when public transport is so much cheaper? So what Lyft is doing in terms of spending money is it's trying to get more supply, i.e. more drivers. If it gets more drivers, it has less surge pricing, it's cheaper for the customers, and it's also easier for the customers to get fares. So these companies would prefer to have more cheaper fares.
I mean, of course they would. We all would. But does it also, is there a problem with the sector?
It's not that straightforward, though, because actually you could say...
But is there a problem?
You could say that actually they want to have fewer, more expensive fares if you're if Lyft itself. So that, but they prefer the Zach one, sorry.
But it does put off the customer. I mean, why would I pay more when I can get the traditional camera? So it seems counterintuitive. I mean, they could do it, but that doesn't really make that much sense business-wise, right?
Exactly, yeah. Because the thing is with the sector is that they have two challenges. They're competing for customers and they're competing for supply. They're competing for drivers. So if you think about the big tech companies like Apple, well, Amazon, Facebook, Google, they're the gateway for supply, and they're also sort of the only places you can go, right? If you want to sell things online, you kind of have to go to Amazon. If you're a driver in the ride-hailing business, you can go to Lyft, you can go to Uber in the UK, you can go to Bolt. There are all these different places you can go. So they're competing on price and they're competing on cost.
Yeah, great. Thank you so much. Our Alex Webb there from Bloomberg. Quick take. Now let's get back to Freya Beamish, head of macro research at TS Lombard. Freya, when you look at some of the tech companies, I don't know whether they're deflationary and whether this has a huge impact on us, how we measure and how we measure inflation going forward.
Yeah, it's almost like the same as commodities. The cure for high commodity prices is high commodity prices. That sort of rings true for what you guys were just talking about with respect to some of the tech companies. And I think the problem that we've seen at the moment, or that we are seeing at the moment, is that there just has been this over-extrapolation from the experience of the past 2 years into the future. And I think if you look at it, I'd almost put tech in the same bundle as goods spending, because they've been the other kind of beneficiary of the pandemic in terms of spending and in terms of inflation. And if you look at goods inflation, if you look at the level of goods prices over the pandemic, we've lost the benefit of nearly 2 decades worth of productivity growth and the integration of China into the global economy, over which time you had deflation in goods prices. And the same is kind of true with a lot of the services that were boosted by the pandemic as well. But this was a 2-year period, which was a completely abnormal period. And I'm not saying we're going back to what we had before, but there has to be some kind of a reversion to trends. And this is really the kind of the third cycle that is ending at the moment. Earlier, we talked about the ending of the asset cycle in the US since the global financial crisis, China's credit cycle. But there's also this COVID cycle that is ending at the same time. And that's where you get the scare in earnings that coming kind of most to the fore at the moment.
But Freya, are we confusing, and we had Paul Donovan of UBS earlier on, and he was saying, a lot of economists are confusing basically the wage spiral with labor productivity gains. What are you expecting wages in Europe to be?
So I think wages and inflation, there's the impression that there's a sort of a spiral going on there. But actually what you've had is you've had negative supply shocks in both of those. And you've had in the US, which has spilled over to everywhere else, a positive aggregate demand shock. And you've had this compositional shock in terms of the spending that's shifted towards the kind of pro-pandemic goods and services and away from the kind of in-person services. And that all gives the impression that you've got this sort of wage price spiral in place. You may get that further down the line. Actually, I think what you're more likely to get is a credit price spiral rather than a wage price spiral, because I think a lot of the accelerators that you had in the 70s are just simply lacking at the moment. But I think that at the moment it's a bit of a mirage that you have fast wage growth and fast inflation at the same time. It's because there's a lack of labor supply.
Yeah. Freya, brilliant as always. Thank you so much for joining us. Freya Beamish there, head of macro research at TS Lombard. Now, coming up later this hour, delivery diversion. Italy's largest employer, Poste Italiane, say it will further diversify this year with plans to start selling energy services. We speak to the chief executive, Matteo Del Fante. He's at 9:30 a.m. London time, and this is Bloomberg. Economics, finance, politics. This is Bloomberg Surveillance Early Edition. I'm Francine Lacqua here in London. Now let's get straight to the Bloomberg First Word News. Here's Leanne Gerrans. Hi, Leanne.
Hi, Francine. U.S. Vice President Kamala Harris has accused Republicans of attacking women's rights following news that the Supreme Court is poised to strike down Roe versus Wade. In an address, Harris said that a court decision on abortion would open the door to stripping away other rights, including same-sex marriage.
Women's rights in America are under attack. How dare they tell a woman what she can do and cannot do with her own body? How dare they? How dare they try to stop her from determining her own future? How dare they try to deny women their rights and their freedoms?
Now, residents of Beijing are being urged not to leave the city unnecessarily as the Chinese capital ramps up COVID restrictions. Schools are also to suspend 4 in-person classes for the next week. In Shanghai, the city's final exit from a punishing 5-week lockdown is being delayed as infections continue to appear outside the very strict quarantine system. A venture capitalist backed by former President Donald Trump has won a Republican primary in the U.S. state of Ohio. 37-year-old G.D. Vance, who is making his first bid for public office, beat a crowded field to become the party's Senate candidate. Global news 24 hours a day on air and on Bloomberg Cryptech, powered by more than 2,700 journalists and analysts in more than 120 countries. I'm Leanne Gerrans. This is Bloomberg. Francine.
Leanne, thanks so much. Certainly, the midterm elections have become a lot more interesting. Coming up, delivery diversion. Italy's largest employer, Poste Italiane, says it will further diversify this year with plans to start selling energy services. It'll be a great conversation with the chief executive, Matteo Del Fante. We'll talk about wage increases, price pressures. We'll talk about Russia, energy, and of course, your delivery packages. Can they really compete with Amazon? This is Bloomberg. The 75 basis point question: when the Fed says hike, traders ask how high and how fast. A new raft of sanctions. The EU proposes to phase out Russian oil by the end of the year. It also aims to cut off Sberbank and other lenders from SWIFT. And U.S. Vice President Kamala Harris accuses Republicans of attacking women's rights, with the Supreme Court poised to strike down Roe versus Wade. Well, good morning, everyone, and welcome to Bloomberg Surveillance Early Edition. I'm Francine Lacqua here in London. Finally, Fed Day. I feel like we've been waiting for this May Fed decision for as long as I can remember. This is what's priced into the markets. Of course, it's a 50 basis point hike. Will we get it? Will we get more? Could we get less? Unlikely, but this is something that, of course, we always need to keep in mind. Bonds falling today, U.S. equity futures pretty much a little changed. Again, investors are really bracing for the biggest Federal Reserve interest rate hike since 2000. What they want to know is, what will Jay Powell do? Will he aggressively tackle inflation? What does it mean for the Fed balance sheet? And the most interesting bit, apart from the U.S. 10-year yield, which is at 2.9695, is a gauge of the dollar holding to a 2-year high. What you look at dollar strength, of course, reflects caution over an array of risks, not only tightening financial conditions, but also China's COVID lockdowns and Russia's war in Ukraine. So the European Union plans to ban Russian crude oil over the next 6 months and refined fuels by the end of the year. Here's what Commission President Ursula von der Leyen had to say on the sanctions package.
So today we will propose to ban all Russian oil from Europe. This will be a complete import ban on all Russian oil, seaborne and pipeline, crude and refined.
Well, Bloomberg's Europe correspondent Maria Tadeo is with us in Germany. So, Maria, if you break down the announcement, how likely is it that this will get full support and it will go through, that we'll have more sanctions and it will manage to phase out Russian oil in the next 6 months?
Yes, Francine. And today we finally heard it official by the head of the European Commission. This is a new package of sanctions that will target now oil. You heard it from Ursula von der Leyen herself. This will be a transition from now until the end of the year, but would likely see the end of Russian imports by the end of 2022. Now, 2 important things here, Francine. One is that there will be a special regime for countries like Hungary and Slovakia. Remember, they had said they wouldn't support this embargo because it would have a detrimental impact on their economy. They will get a special treatment up until 2023. So that could get this announcement today through the finish line. And the other thing, Francine, this is not just about oil. It really is about all the services around it. So, of course, I mean the transportation around it, the insurance of cargo ships, the brokerage that comes with it. So it would be a full phase out also of those services around the oil industry by the end of the year. Now, if you ask me, are we going to see an agreement on this? I guess the fact that Hungary does get some kind of carve out of this does mean that we're going to get it through the finish line and possibly by the end of this week.
Yeah, I mean, the $1 million question, I mean, this feels inflationary. So the $1 million question is, what does this mean for central banks? And also, how will Vladimir Putin react?
Yes, and Francine, this is not going to go without reaction from the Kremlin and Vladimir Putin, particularly ahead of that May 9th parade. This is the big victory parade that he's going to oversee in the Red Square. Now, remember, there's two key points coming up. One is that ruble for gas payment system that he says he wants. There's a big deadline coming up in mid-May. Is he going to turn off the taps? That is potentially something he could do in retaliation for the money he's going to lose on the oil. And then the other big question is this going to put an end to the war in Ukraine? Will this be enough to make him rethink his strategy? If you look at the language coming out from the Russians, it's not the case. The Russians continue to say they will achieve victory in Ukraine. And today, again, we're reporting once again that Vladimir Putin could try to annex some of these territories, but also declare full war in Ukraine come May 9th.
Yeah, I feel like there's no turning back, but hopefully I'm wrong. Thank you so much. Our Europe correspondent there, Maria Tadeo, for us in Germany. Now, Bloomberg Intelligence sees Italy as one of the hardest hit economies in the euro area from soaring commodity prices because of its high reliance on Russian natural gas. Listed on the Milan Stock Exchange, state-owned Poste Italiane is Italy's largest employer. In today's world of digitalization, the 160-year-old mail company has had to diversify into financial services, logistics, and more recently, selling energy services. Well, I'm delighted to be joined here in the studio live for an in-person conversation is Poste Italiane's Chief Executive Officer. He's Matteo Del Fante. Thank you so much for joining us. Also, it's so nice to have a proper conversation because we haven't been able to catch up for quite some time. Okay. If you look at all the pressures that you're dealing with on a daily basis, you're Italy's largest employer, there's wage inflation pressures. I mean, you don't have an easy job. Do you have to increase wages to at least align with inflation?
Wages were okay. We signed a contract in July 2021, which covered 3 years, and our employees are happy with that contract. The pressure is coming on other front, on the inflation side.
So where do you see the main pressure for you? You have to basically, you're diversifying, it's financial services. I mean, I was trying to explain to the newsroom, the relationship that Italians have with Poste is different because it's like one of your main, this is where you buy a lot of the services.
Yeah, and we are trying to be a platform, at a national level, a platform company, which means we want to be relevant for our clients, relevant with our physical, 13,000 offices, and then we have another 50,000 franchise points, and we want to be relevant in the digital space. And the two things we believe are kind of, two sides of the same coin. And that is at the moment proving the right strategy because we're seeing turnover going up. Notwithstanding, we are sitting on some secular trends on the way down. Mail is going down.
Parcels are going up. I mean, I get so many parcels.
Parcels are going up. You've seen, results announced by, the Amazons, the DHL. The first quarter was down year on year versus 2021 because we had a peak year, but all of them are up versus 2019, so pre-COVID.
So Matteo, what's hardest for you right now? If you look, I mean, do you have a lot of competition from DHL? And I know we maybe have less parcels than the peak of the pandemic, but this is still the way of the future.
Yeah, we have a lot of competition from all the guys. I mean, there is the Amazon in sourcings. There is, Bartolini, which is a company owned by French La Poste. We have a very strong presence of DHL in Italy. We have FedEx. We have UPS. We don't miss friends in the space. But we managed to become number one B2C delivery company last year. We started in 2017, we were number 6 in logistic. So, we've done some inroads.
I mean, I'm so embarrassed. I actually know my DHL driver and other ones personally, so I don't know what it tells me about my shopping habits. But talk to me a little bit about selling energy services.
Yeah.
So again, when you're looking at the war in Ukraine, how difficult is it? Yeah. So you sell a product, but you say, this may go up quite significantly for you.
Yeah, I mean, it's planned for 2022, and it was planned, a couple of years ago, and it will happen. We're doing the last mile, so we're selling the energy that we buy wholesale. So all we need is a decent level of stability in the wholesale market where you hedge what you sell to your clients. This is part of the liberalization commitments that the Italian government took versus the European Commission for the Next Generation EU. You know, there is a lot of things that have been asked to Italy in the package, and one of the things is you have to liberalize your sale market in energy. So there are buckets of clients which are still protected under specific contracts that will have to migrate towards the market. So it's an opportunity for a company that is selling products to clients.
At a tricky time, though, because of what's happening in Ukraine. So what do you need from regulators? What do you need from Europe?
We were seeing some moderate stability in the gas market, in the forward market in the last couple of days. Let's see the news of this morning on oil. Clearly, this is a strong stance. The cap on price of gas is clearly, a big question. I really hope that it's not going to happen scatter, country by country, because that's not helpful.
What's your biggest concern for the Italian economy right now? Again, you're such a large employer that you really have real-world expertise about what we're living through.
I think that if the commitments that the government has taken in terms of reforms, I'm talking about public administration, I'm talking about justice, I'm talking about procurement, take place, the economy will benefit. Clearly, the war and the exposure that many Italian companies have towards Russia are, slowing down the growth. But I think it's very important that those reforms are taking place.
How much will your costs go up because of this? Rising inflation, rising raw materials, the price of energy. How difficult is it actually to forward guidance?
Yeah, we have. We were lucky. We hedged ourselves pre-war, basically up to the end of 2023. In terms of gas and electricity. So we are sheltered. Yeah. We face an increased cost on oil and petrol because that's very hard to hedge. So all our 26 million vehicles that have to we have to buy petrol for them. That's going to be, but it's a marginal weight, and we're trying to make some savings elsewhere.
And are you seeing a dip in consumer demand? I mean, you have really the
we
world
have
data, right? Before anyone
we
else.
have all the information we need. We don't see an increase in savings. Let me put it this way. Usually, when people are concerned for the overall, they save more, and we see more money kept in the checking account or deposits. We don't see that yet. Consumption data, we see standard turnover in card payments. We do more than 2 billion. We're the biggest payment company in the country, so we see a lot of flows there, and we don't see a slow in consumption.
Okay, really interesting. Thank you so much, Matteo Del Fante, their Chief Executive Officer of Poste Italiane, joining us for an exclusive conversation. Now, we're just also getting an announcement from the Indian Central Bank. This is the RBI turning hawkish last month as inflation jumped. So we're looking at live pictures, traders pricing in the most aggressive hikes in the region for the central bank. And the very latest is they voted to hike a key rate by 40 basis points. Coming up, Vice President Kamala Harris accuses Republicans of attacking women's rights as the Supreme Court looks poised to strike down Roe versus Wade. We'll bring you the latest from Washington. That's coming up next, and this is Bloomberg. Economics, finance, politics. This is Bloomberg Surveillance Early Edition. I'm Francine Lacqua here in London. Now, the Indian Central Bank has announced that it would raise the benchmark rate by 40 basis points to 4.4%. We're seeing a bit of move on the Indian 10-year yield, rising 28 bips to 7.40%. That's the highest since 2019. So they're also dealing with inflation. This has been a bigger problem for longer in India, but of course that was something that the market, I don't think, was really expecting it. So the RBI did turn hawkish last month and inflation jumped. Traders had priced in the most aggressive rate hike in the region for the central bank, but today, again, 40 basis points hike is something that we need to sit up and watch. Now, President Biden has urged the election of more lawmakers who support abortion rights and will seek to enshrine protections into law. This was a 6-3 conservative majority Supreme Court poised to overturn the landmark Roe v. Wade ruling. Now, Democrats currently lack the votes to pass the legislation, even by a simple majority. Meanwhile, Vice President Kamala Harris has accused Republicans of attacking women's rights. Joining us now is Therese Raphael from Bloomberg Opinion. Therese, thank you so much for joining us. Many questions actually about, first of all, what does this do economically? How difficult is it to model, to understand whether it significantly increases inequality if this becomes law?
Yeah, I think that's a big question, and that is the one that the states are going to have to deal with now. Yeah. If this Supreme Court decision that has been leaked holds, the onus will then be on the states that are passing restrictive abortion legislation to try to mitigate the effects of that. So we know that we would expect about half of U.S. states to restrict abortion. And among those that have already passed trigger pieces of legislation, their incomes are below the national average. We also see more black women, more ethnic minorities seeking abortions. So it is going to impact healthcare inequalities, which we know are already quite significant in the U.S., and have a knock-on effect for economic inequality as well.
So is it something that states would actually, consider giving support to the people affected the most, or is there a danger that, again, this gap just widens and no one's going to do anything about it?
Yeah, I mean, it's amazing that the argument has been termed pro-life, because what it really is pro-birth. We still have the highest maternal mortality rates almost anywhere in the developed world. We still have no federally mandated maternity leave for women in the U.S. We have very little access to health care for women, and we see a much higher rate of problems with particularly young, unmarried women living below the poverty line, and they are by and large, the ones who are more likely to go seek abortions. Your average woman that's seeking abortion, she's not a teenager, she's in her 20s, about nearly 60% live below the poverty line. They're likely to have more than one child, be less likely to travel long distances to access an abortion. So that is where the impact of this decision is really going to be felt. And the question is really, what are the states going to do to mitigate that impact?
What do you think they can do? Or are they thinking about what they can do?
I mean, there's been legislation, there's been discussion to increase the ability of adoption. Yeah. But that is just a very small part of what's really required here. So there needs to be full support for women in pregnancy, particularly in birth, after birth. And we also know that women who are more likely to seek abortions are less likely to drop out of school. They might have more job prospects and income earning opportunities for those choices. So the flip side of that is if you decrease access to abortion, you then have to support women who may be financially unable to support children. And I don't think we've really had a discussion that goes into that to anywhere near the level that's needed. But the Supreme are making the decision on Roe v. Wade. It's then going to be to the states, to politicians, to figure out how to deal with the impact of it.
Yeah, huge. I mean, it's like an earthquake, of course, hitting U.S. politics. Therese, thank you so much. Therese Raphael there from Bloomberg Opinion. Now, coming up, ESG fund flows take a smaller hit than non-ESG last quarter. We speak to Jennifer Wu. She is Global Head of Sustainable Investing at JP Morgan. That's coming up next, and this is Bloomberg. Economics, finance, politics. This is Bloomberg Surveillance, early edition. I'm Francine Lacqua here in London. Now, global sustainable funds attracted some $97 billion in net new money last quarter. And according to Morningstar, the decline in ESG flows were roughly half as steep as that seen in non-sustainable funds. It suggests that ESG held up comparatively well as investors reacted to rising inflation and the war in Ukraine. Well, we're delighted to be joined now by Jennifer Wu, Global Head of Sustainable Investing at JP Morgan Asset Management. Jennifer, thank you for joining us. When you look at fossil fuels, because of the transition, because of the need to get away from, of course, Russian dependency, where do fossil fuels stand in this transition to a more sustainable environment?
Yeah, hi, good morning, Francine. Good to join you here. It's such a great question because I think with everything that's happening since the beginning of the year, the war, the invasion, it really has served as a catalyst to accelerate the transition to a low carbon economy, right? The recognition of how not only climate change and climate transition is something that we need to be mindful of from an investment standpoint, as it presents a tremendous amount of risks and opportunities, but also at the country and regional geopolitical level, these are issues that we actually need to be really mindful of. So I think it has really served as a catalyst as we see how in Europe, for instance, the ambition is to really increase the share of renewables to 40% by 2030. And we see many countries have come out to really amp up their ambition to really increase renewable energy such that they can reduce their reliance on fossil fuels from certain locations. So I think it's been a really good and important catalyst for the overall climate transition.
Jennifer, some financial market participants, EQT comes to mind, are requiring that their investee companies sign up to the Science Based Targets initiative to ensure that they're headed in the right direction. What is JP Morgan planning?
Yeah, so we have been really focused on engaging with companies, not only asking the question of, do you have an ambition to align yourselves to a low carbon economy, how that impacts your business mix, but really scrutinizing the plans and strategies that they put out. And of course, science-based target initiatives or transition pathways, these initiatives and standards out there help us to better understand and be able to compare one company to the other in a more consistent way. But I think at the end of the day, there is still a lot of nuance in the underlying plans and strategies that companies put out. So investors have to, still do the homework and scrutinize the plans so that we can ensure that it is very much linked to how companies are planning CapEx, R&D, and then also that plans that they put out is realistic.
Jennifer, critics say that ESG have become more about the financial industry moving stuff around, actually, than doing a positive impact. Do they have a point, and will it change?
Well, I think it's an interesting comment. I do believe that what we are seeing now in the market is that ESG is not really just for dedicated sustainable funds that have exclusions, right? What we're seeing is that ESG factors are now being more integrated into mainstream investing. So things such as climate transition related risks and opportunities, that's not really just for sustainable funds, right? So every fund or every investment need to take into consideration the potential impact of physical climate risk. And similarly, like what we're seeing in the US with unionization and how that impacts human capital and productivity of the labor force, like these are issues that are not only considered by dedicated sustainable funds. So I don't think it's a matter of moving stuff around. It's really about presenting with ultimately end clients with different kind of choices, right? Is inclusions more important to you by way of doing engagement and making sure that we can promote change, or is exclusions more important to you and aligned to your values?
Jennifer, thanks so much. Jennifer Wuther, Global Head of Sustainable Investing at JP Morgan Asset Management. Now, Bloomberg Surveillance Early Edition continues in the next hour. Kruti Gupta, Kailey Leinz in New York. Our Ann Edwards is here in London. It's Fed Day. Couldn't come sooner. We've been waiting for this Fed Day for what feels like a decade. No, I'm kidding. Just a couple of months. But actually, bonds are falling. U.S. equity futures fluctuating as investors bracing for the biggest Federal Reserve interest rate increase since the year 2000. We want more clues on how aggressively the Fed will tackle inflation. This is Bloomberg.
The uncertainty is bigger than ever.
You look across the globe, global forecasts for growth are being revised down.
I think we're approaching peak anxiety or peak fear, but let's be honest, I don't think anyone can consistently call the absolute bottom or the absolute top.
I think that the Fed wants to stop being a source of volatility.
This is Bloomberg Surveillance, Early Edition, with Anna Edwards, Matt Miller, and Kailey Leinz.
It's 10 a.m. in London, 5 a.m. in New York, and 5 p.m. in Hong Kong on this Wednesday, May 4th. Our top stories today. The Fed's set to unleash its biggest interest rate hike in more than 2 decades. It will also announce plans to shrink a nearly $9 trillion balance sheet. Meanwhile, India just raised its key policy rate in a surprise move. The European Union ramps up the pressure on Vladimir Putin. It plans to ban Russian crude oil over the next 6 months. And the arrest of billionaire investor Bill Wong may be just the start. U.S. investigations into questionable trading practices are on the rise. Welcome to Bloomberg Surveillance Early Edition. I'm Anna Edwards in London with Kailey Leinz and Kriti Gupta over in New York. Matt Miller is off today. And Kailey, we have a twin focus for markets today. Yes, the Fed and the global central banking narrative, but also what the Europeans are doing when it comes to sanctioning Russia.
Yeah, as always, Anna, there is a lot of news to digest and to wait for as well. That was definitely the case in Asia overnight, although you still had some key markets closed, including Japan and China for holidays. But Hong Kong was open for trading and traded lower. Really a move led by technology. The Hang Seng Tech Index falling more than 3%. That after news of an SEC probe into DiDi Global, of course, the Chinese ride-hailing giant that is listed here in the United States. Regulators here looking into that chaotic public debut of 2021, and that's creating a bit of a sentiment overhang on Chinese tech stocks more broadly. But of course, Anna, and you mentioned this, one of the big developments in the last 30 minutes was the surprise rate hike out of India. An unscheduled move higher by 40 basis points to 4.4%. And you're seeing that ripple across Indian assets, including the rupee, stronger against the dollar by about 0.4%. And in the bond market, that 10-year yield in India up a whopping 26 basis points, 7.37% or so. That is the highest going back to 2019. And of course, that surprise hike from the RBI today followed a bigger than expected hike from the RBA overnight yesterday in Australia. And of course, you're seeing that continue to ripple through the Australian bond market. Kriti, up nearly 15 basis points on the 10-year today. 354 is where we sit. That is the highest going back to 2014.
Yeah, Kailey, well, stateside, we do have a little bit of green on the screen, but remember, it is Fed Day. Happy Fed Day, I should say, to our worldwide TV and radio audience. A little bit of marginal moves here when it comes to futures trading, but remember, it is still a wait-and-see mode. We have to see what the Fed says about the balance sheet in particular. That's likely to sway the benchmark in either direction. No movement really in the 10-year yield, even though you are seeing that bond market move around the world. Once again, really anchored to what we're going to hear from the Fed. But I think all the action is really happening in the commodities market this morning as we hear about those EU sanctions against Russia. Remember, the last time this was brought up, banned oil imports, JP Morgan was expecting $185 oil. Of course, we are a far cry away from that, but still up about 3% when it comes to NYMEX crude, and Bitcoin up 3% as well. Let's see, though, if it stays as we talk more and more about what the Fed might do, Anna.
Yeah, absolutely. And mindful of what the Fed might do, mindful of what central banks globally are doing when it comes to tightening policy, of course, aside from some important markets like China, we see a little bit of weakness coming through on the European equity market space today. So some moves lower for stocks, down by around 0.4% on the FTSE 100 and on the CAC 40. Perhaps it is fears around inflation and higher commodity prices that is doing some of the damage. Energy stocks, one of the sectors doing quite well, as you might expect, given that we do have higher energy prices today. Kriti was talking about WTI. Here's the Brent price. 108 is the handle on the Brent price, up by 3%. Not up to $180 a barrel, as Kriti was saying, as we had been warned about. But perhaps that is the strength of a phased approach. That is the strength of what the Europeans call an orderly approach. It's not going to be immediate, certainly, the ban on Russian oil assets. We've got in here the Bloomberg Sterling Aggregate yield. And this is the yields or the cost, really, to UK businesses raising money, or those raising money in sterling at least, what they have to pay on that debt. And that cost for that debt is rising. The yield is rising, and it has risen to a level that is higher than we saw at the height of the COVID pandemic. And so that is giving some people reason for thought, for pause, just a day before we get to the Bank of England meeting. Of course, higher borrowing costs, very much the order of the day. Just Eat Takeaway, this is, as the name suggests, a takeaway online ordering business based in the Netherlands. The stock down by 6.8%. The COO seems to be facing some allegations of not behaving well, and as a result, the stock is moving lower. The chairman also not putting himself up for re-nomination, and that is weighing on the stock. Skanska, a construction business here in Europe, and they are talking about supply chain difficulties linked to the war in Ukraine, and that weighs on that particular business today. A focus on Russian assets is worthy today, then, as we have got quite a lot of news when it comes to the Europeans and the ban that is going to be brought in on Russian oil coming into Europe. We see moves lower on the stock story in Russia. Part of this is also to do with Sberbank is now being taken out of the SWIFT system, or de-SWIFTed. That seems to be the verb that we are able to use these days, but not able to use that SWIFT payment system in the banking space. And so that is weighing on stocks, it would seem, over in Russia. The ruble rallies, but we're told again and again by investors, by traders, that this is pretty much a broken market, Kailey.
Anna, just some breaking news we wanted to mention out of China. Local government officials in Beijing are giving a briefing on COVID-19 and say that Beijing will extend restrictions that have been put into place during the holiday. Of course, the May Day holiday, which the last day of it was today. Those restrictions include halting dining in at restaurants, as well as a closure of gyms, requiring some testing for places like parks and monuments. You would have to have a negative COVID test to get in. We've seen the shuttering of schools as well. So continuing to monitor those developments in China as they deal with an outbreak of COVID-19. Now, in addition to monitoring that, let's talk about what else is ahead today. We will be getting some U.S. economic data, including MBA mortgage applications, as well as trade balance. Then Uber will be reporting its results at 7 a.m. New York time. That report was actually moved up. And then, of course, the big event of the day, Creedy, the Fed decision, 2 p.m. New York time.
Yeah, well, let's stick with that, Kailey. Chair Jerome Powell poised to unleash the central bank's most aggressive action to battle inflation in decades. Michael McKee, Bloomberg International Economics and Policy correspondent, joins us from our D.C. bureau. Mike, thank you as always for getting up early for this, what is poised to be a historic day in the from the Federal Reserve.
Yes, Creedy, it was 2000 when the last time the Fed raised 50 basis points was, and it was just before a recession. So that's the question in the markets. It's not what the Fed's going to do, but how the economy reacts, and does the Fed have to get even more aggressive given what's been happening this morning? You can see in the WIRP function on the Bloomberg that traders have almost priced in a 75 basis point move for June. We're expecting 50 today. So a lot of people are going to be looking to Jay Powell when he holds his news conference at 2:30 New York time today to give us some sort of indication of whether it would do that again, whether it's that important. This is, as I say, the first 50 basis point hike since 2000. But it's not really where they are. It's where they're going that everybody's wondering about. Where do they end up? 2.5%, 3%, 3.5%. They've said they want to get to neutral by the end of the year, and that's going to be the real question. How quickly do they move? And now we've had this news this morning about an oil embargo of Russia, and as Kailey was just saying, extended lockdowns in China. Those are only going to add to inflationary pressures. So a lot building up for Jay Powell and the Fed.
Yeah, absolutely. And Mike, the global agenda is interesting when it comes to central banks around the world hiking, and India's central bank delivering a surprise hike today, coming on the heels of surprises in some shape from the Australian central bank. Hawkish surprises seem to be something we're getting used to.
Yes, it is, I suppose, possible the Fed could go more than 50 today, given what's happened in Australia and in India. The Indian central bank governor pointing out inflation is just getting worse, particularly food in their country because of the war. And tomorrow we have the Bank of England expected to raise rates and start talking about the possibility of QT, quantitative tightening, selling off some of their sterling holdings. So it is a different environment than people are used to. And very quickly, we're not going to be where we were for the last 2 years. We'll even get back perhaps to the place we were right after the financial crisis of 2008, when you get into 2017-18, when they started raising rates.
Mike, thanks very much. Bloomberg's Mike McKee with us to talk us through the Fed story. And stay with Bloomberg for special coverage of the Fed decision and the news conference. That is at 1 p.m. in New York, 6 p.m. in London. On to our other top story today, and the EU plans to ban Russian crude oil over the next 6 months. That's part of another round of sanctions to increase pressure on Vladimir Putin over his invasion of Ukraine. European Commission President Ursula von der Leyen spoke to the European Parliament this morning.
We will make sure that we phase out Russian oil in an orderly fashion, so in a way that allows us and our partners to secure alternative supply routes, and at the same time be very careful that we minimize the impact on the global market. And this is why we will phase out Russian supply of crude oil within 6 months and refined products by the end of the year.
Let's get more with Maria Tadeo, our European correspondent, who's reporting from Germany for us today. Maria, tell us more about the sanctions there. And we heard Ursula von der Leyen speaking about oil taking the headlines, but there's more detail.
Yes, Anna, and this is a new package put forward by the European Commission. The head of the Commission, von der Leyen, today said this war in Ukraine needs to have a price, and Vladimir Putin is going to pay for it. Now, when you look at the measures announced today, clearly the takeaway is that oil embargo, but there's some details here that are worth keeping in mind. Yes, it's a full oil embargo, but only by the end of the year. There is a 6 to 8 month transition period so that countries like Germany, by the way, where I'm in today, will have time to adjust for it. And then, of course, there's a number of strings attached that come with it. There will be a special regime for countries like Hungary, Slovakia. Remember, at one point, they said they would not be on board with this embargo because it would be detrimental to their economies. A lot of this is designed to get this new package through the finish line. It will also target Sberbank, the Russian bank. And it's not just oil, Anna, but it really is the services around it. The European Union says it will put an end to things like the transportation, the brokerage, the insurance that comes with those oil ships into the European Union. The big question now is, how is Vladimir Putin going to respond to this? Remember, the Kremlin has said it will go tit for tat on countries that are, quote, unfriendly with Russia. And then, of course, this is going to put an end to the war. Will this make Vladimir Putin rethink his strategy in Ukraine? Well, if you look at the language coming out of the Kremlin, it's the opposite. The Russians say they will achieve victory in Ukraine. And of course, we hear that a lot of the focus now will be on the east and incorporate in some of the occupied territories by May 9th. That is a big victory parade. The Soviet Union victory over Nazi Germany for Vladimir Putin is a key date.
Well, and Maria, of course, what's happening in Ukraine is a big focus in Germany today. You're in Meseberg as the German government wraps up a 2-day special cabinet meeting. Really, what's the focus of that?
Well, a lot in focus, Kailey, because this is a country and a government. Chancellor Scholz, by the way, will be here alongside his top ministers. This is a country, as I said, that is having to almost undo in real time, in record time to some extent, about 15 to 10 years of appeasement when it comes to Russia, this trade-led foreign policy. Germany, many would argue the issue here and the big criticism is that it failed to separate security from politics to energy. All of this is coming now undone. So clearly the focus will be now on how to recalibrate this. And by the way, Kailey, it's not just Russia, because that is a supply shock, but there's also a demand issue here coming potentially from lockdowns in China. So this is a turbulent time for the German economy, no question.
Bloomberg's Maria Tadeo reporting from Brandenburg, Germany. We thank you as always. And from Germany, let's return stateside. President Biden urging the election of more lawmakers who support abortion rights following news that the Supreme Court is poised to strike down Roe versus Wade. U.S. Vice President Kamala Harris also weighed in on the matter yesterday.
Women's rights in America are under attack. How dare they tell a woman what she can do and cannot do with her own body? How dare they try to stop her from determining her own future? How dare they try to deny women their rights and their freedoms?
Anne-Marie Herdern, our Bloomberg Washington correspondent, joins us now. Anne-Marie, day 2 of this saga, and emotions clearly running high.
Yeah, this was probably the most impassioned and robust speech we've heard yet from the Biden administration, and on the heels of also the president talking about this, and the president really pointing the finger to the fact that if this is overturned and the Supreme Court does strike down this 1973 law, which gave women the constitutional right to seek an abortion, reproductive rights for women will be top of the agenda for the upcoming elections. And really where the world is going to, and analysts are going to be honing in on, is suburban women, because rural parts of America really are Republican. Then you have very much strongholds in cities for Democrats. It's suburbs where really elections can be won. We saw that in 2018 when the Democrats gained a number of seats in the House, 41 seats they picked up. We also saw that in the last presidential election, where President Biden, this was a pivotal moment. He was able to pick up that suburban vote, and women are going to be top priority for them. And this may be an issue that can eclipse everything else, including inflation and COVID-19.
Well, while we're talking about elections, Anne-Marie, we also have to talk about what we saw happen in Ohio yesterday. The Republican primary for Senate, J.D. Vance, the venture capitalist endorsed by President Trump, winning victory there. How much should we read into that as an indication of how midterms are going to go?
Yeah, it was a very crowded race. He beat out 6 other individuals for this, and he picked up that Trump endorsement that does seem to help him and push him over the line at a moment where he was not as high in the polls as some of his other challengers. Analysts say we shouldn't read too much into this just yet. This is just one race, but certainly with J.D. Vance, as you say, this venture capitalist backed by Peter Thiel as well. Also, many have read his book, Hillbilly Elegy. It's not just him that has won this race now. This was a big moment for the former president, who's, of course, trying to make sure his stature in the Republican Party. And as he talks about these other candidates he's going to endorse, he also flirts with the idea that he himself will run again for president in 2024.
All right, Bloomberg's Anne-Marie Horton in Washington for us. Thank you so much. Now let's get back to the markets and take a look at some stocks moving in pre-market trading here in the U.S. I have to begin with the big plunge to the downside that we are seeing for Lyft. It, of course, reported after the bell yesterday. The issue is not demand. They are seeing a robust demand recovery as people emerge from their pandemic-era habits. The issue is they can't attract enough drivers, a problem that has only gotten worse as gas prices have gone up, which really crimps the take-home pay for those drivers. So Lyft is going to spend more on incentives to get drivers in the cars. The problem is that's going to weigh on profitability. Dan Ives over at Wedbush saying that spending like an 80s rock star is not going to fly with investors, and it certainly is not flying with them this morning. That stock down 26% before the bell, taking Uber down with it, which of course will report later on this morning. Uber is down 4%. A different story, though, when it comes to Starbucks. Yes, they are facing a big issue in China with the lockdowns. That's why they suspended their 3rd and 4th quarter guidance because of a lack of visibility. But ex-China, everything else is looking pretty good. So that stock is up about 6.3% before the bell. And another upside move for AMD, the chip maker, giving a strong forecast, indicates good demand for its data center chips. As a result, that stock up about 5.5% before the bell, Anna.
Kailey, coming up on the program, Chris Watling, Longview Economics CEO and Chief Market Strategist, will join us. What is he expecting and looking for from the Fed? And Wall Street crackdown. The Bill Wong case is just the first in an upswing of federal investigations into a slew of suspected trading abuses. More from our big take story. That's still ahead. This is Bloomberg.
This is Bloomberg Surveillance Early Edition. I'm Kriti Gupta with Kailey Leinz in New York and Anna Edwards in London. Matt Miller is off today. We are staring at a potentially historic rate hike in the books today, a 50 basis point hike. At least that's what's priced in the market. But I want to go back to the last time we were looking at financial conditions and when they were this tight as they were, taking into account the stock move, taking account to the dollar strength and other financial conditions, well, credit spreads, for example. The last time we saw it was back in 2018. And when we were here, the Federal Reserve was actually looking to pause that aggressive tightening policy. Here we are again, and now we're looking at a historic rate hike. What are the parallels we should really be following? Let's get some expertise here. Justina Lee, Bloomberg Markets reporter, joins us now. Justina, thank you as always for making the time. This is really interesting. What is it going to take for the Federal Reserve to ease, just as we're talking about this historic aggressive rate hike regime?
Right. I think your chart really shows the position the Fed is in right now because, today we're expecting them to focus on capping inflation expectations with a 50 basis point hike. But at the same time, we're also seeing signs that maybe demand is cooling, because of the China slowdown or the impact from the war. And as your chart shows, financial conditions have already tightened quite a lot. And so, can the Fed still shock markets by kind of making expectations even more hawkish from here? I think that's kind of the question markets are focused on today.
And broadly, Justina, we've seen, of course, a bond rout taking place as a result of concerns about higher interest rates. Today, we see that the short ends of the Treasury curve, yields are rising there, going down at the long end. And that seems to be the type of market reaction where markets get nervous about slowing growth, about whether the Fed tightens too much. Do we read anything into today's slight flattening?
Yeah, because it's not always in every hike cycle that yields just keep going up. And so I think the question here really is, when do investors start shifting their concerns, from inflation to the prospects of slower growth? But I think for now, the market is still focused on what's going to come out of the Fed meeting today. not in terms of necessarily the decision today, but in terms of the next rate hike coming in June.
Yeah, and with so many uncertainties around commodity prices, which are on the rise this morning, of course. Justina, thank you very much. Bloomberg's Justina Lee. For more market analysis, you can check out the Markets Live blog, MLIV Go. That's the function to use on your terminal. This is Bloomberg.
Keeping you up to date with news from around the world, here's the first word. India is pushing Russia for bigger discounts on oil as other buyers turn away. Bloomberg's learned that India wants to pay less than $70 a barrel to compensate for additional hurdles such as securing financing for purchases. Brent is trading around 108. Elon Musk reportedly wants to eventually take Twitter public again. He has agreed to take the company private in a $44 billion deal, but according to the Wall Street Journal, he has told potential investors he could return Twitter to public ownership within a few years. Coming up, we'll talk about the Federal Reserve decision later today. Chris Watling, Longview Economics CEO and Chief Market Strategist, will join us. This is Bloomberg.
This is Bloomberg Surveillance Early Edition. Here's what you need to know. Federal Reserve Chair Jerome Powell is poised to unleash the central bank's most aggressive action to battle inflation in decades. Policymakers are expected to raise interest rates by 0.5 percentage points when their two-day meeting ends today. Meanwhile, India's central bank raised its key policy rate in a surprise move earlier this morning. The European Union is ramping up the pressure on Vladimir Putin. It plans to ban Russian crude oil over the next 6 months. The EU also will ban refined Russian fuels by the end of the year. And the arrest of the billionaire investor Bill Wong may be just the start. U.S. investigations into questionable trading practices are on the rise. Those probes all center on the same question. Are the markets rigged? We will discuss in just a few moments' time. I'm Anna Edwards in London with Kailey Leinz and Kriti Gupta in New York. Matt Miller is off today. And Kriti, as we started the program, same two thoughts occur. We're watching the Fed. We're also watching the developing sanctions story now into its 6th round from the European Union against Russia.
And that's really where all the market action is, Anna. You are seeing a little bit of marginal gains in futures, not really a ton of movement in the 10-year yield as well, but you are seeing a lot of movement here in the crude, in NYMEX crude, up 3%. And once again, it comes on the idea that if you start to ban oil imports, that's naturally going to be a bullish driver for oil prices. JP Morgan, for example, forecasting that in that scenario, oil would hit $185. We are only at 105 because think about it, we're balancing some of that sanction talk with growth concerns over in China. Earlier in the show, we talked about Beijing extending those restrictions as the second largest oil consumer in the world. You are seeing some kind of tug of war dynamics here in the crude market. Bitcoin up as 3% as well. The question for Bitcoin here, and Matt Miller would be proud that I brought this up, is it that inflation hedge that a lot of people were calling it as we talk about a historic rate hike? I'm very curious, Kailey, to see how Bitcoin in particular reacts to what we hear at 2 p.m. today.
Yeah, and Bitcoin's still in and around that $38,000 level, Kriti, so still in the range, actually at the lower end of the range it has been in for all of 2022, even as inflation heats up. So is it really a hedge? A question we will continue to ask. Now, as for the markets and the moves in pre-market trading here in the U.S., the big underperformer would be Lyft. That stock is down about 26% at this point. The issue here really is that they need to get drivers. They need to pay them, incentivize them more to join up and drive for Lyft. The problem is that's going to weigh on profitability. So a big decline for that stock this morning, and it's dragging on Uber as well. Uber, interestingly, was supposed to report after the bell today. It's now reporting pre-market. So I wonder how much we should read into that, but that stock is down 4% at this point. You also have Akamai down as well after giving a disappointing forecast. The company struggling with slower internet traffic as well as some issues with the war in Ukraine. That stock is down 14%. But Airbnb, a more positive story. Great forecast given. It's really optimistic on summer travel, Anna, kind of joining in a lot of travel peers like Expedia in forecasting a really strong summer travel period as people get back out there after the pandemic. That stock is up about 5% before the bell.
Yeah, plenty of stories about busy airports globally, of course. Let's get back to the European session then, and European equity markets 2.5 hours into their trading day. And we're moving a little lower here for European stocks, perhaps shaken a little by what we've heard from the European Commission in terms of the ban on oil from Russia. That is certainly moving the Brent crude price. Kriti was talking you through the WTI price. Well, Brent crude also up by 3%. Where does that leave us in terms of inflation and the cost of doing business? And maybe that has a European dimension to it. And stocks Europe 600 down by 0.6%. We've also seen some gloomy forecasts from some of the companies that operate within the retail space and are exposed to the European consumer, and that is having an impact. I've also got here the Bloomberg Sterling Aggregate. This is a yield, and this is for high-grade debt, sterling denominated for European corporates. And those that are borrowing in sterling, this is the price they're going to have to pay. And this price, this yield, has now got up to similar levels that we saw during the height of the pandemic. So the concern here is that the cost of borrowing for companies, just a day before we hear from the Bank of England, where the expectation is we see a higher interest rate, that cost is going higher, and the market, certainly that market theme, very much intact for us. Just Eat Takeaway, a takeaway food ordering business based in the Netherlands. The COO of this company having to step aside, accused of misconduct. The chairman also deciding to step away from the business, and that stock down by 7.8% as a result. Russian assets firmly in focus as the EU bans the import of oil from Russia, albeit with a lag. 6 months in the case of crude is that lag. They've also said that they're taking Sberbank out of the SWIFT system, so the SWIFT financial payments system, de-swifting, if you like, Sberbank, and so that is having a negative impact on some in the financial sector over in Russia. So we see stocks moving lower. Here we've got the Russian ruble gaining a little bit, but we're told often that this is a broken market. It seems that Russia has avoided default, at least in the very short term, when it came to those dollar-denominated payments it was due to make just yesterday, just today, in fact, Kailey. All signs seem to point towards they have avoided that default, but we'll see what happens in further payments.
Yeah, of course, emerging market investors watching that one very closely, Anna. They also are likely watching Indian assets today. I just took a peek at the 10-year Indian yield, up 24 basis points on the day after a surprise rate hike from the RBI. And of course, that move followed a surprisingly large rate hike out of the RBA yesterday. Today, it's going to be all about the Fed. Most economists expect that the central bank will deliver a half-point hike, along with hints about further increases. Joining us now to discuss is Chris Watling, CEO and Chief Market Strategist at Longview Economics. Chris, given what we've seen in Australia, in India, how much room is there for a hawkish surprise out of the Federal Reserve today?
Well, it's possible, of course, but I mean, the Fed's language has been extremely hawkish, really, for the last few months. Really since the minutes in early January, they've been dialing up their rhetoric, culminating with discussions of potentially a 75 basis point hike from one or two governors over the last few weeks, and a sense that QT is about to happen and about to be announced later on today. So I think, if anything, there's a bit of a risk of a surprise the other way. The market's been teed up to be very hawkish, to expect hawkish commentary. It's had a lot of Jerome Powell banging the drum along with all the other governors. And I think there's every chance that they may feel they've priced a lot in, and they may even just dial back a tiny bit. Not much necessarily, but a tiny bit.
So, Chris, is what you're suggesting, though, that if they were to move 75 basis points, the market would be fine with that?
It depends how they do it. If they move 75 and make it a statement and it allows them just to ease off a bit in terms of rhetoric or something, or they do 75 and they make acknowledgement that there's some softening of growth and therefore inflation is likely to follow. It depends exactly how they do 75. If they just do 75 and say, actually, we're more hawkish, we're going to do another 75 probably in a few months' time, then that would be taken poorly, I think, in terms of, it's a doubling down on that hawkish rhetoric. But as I say, if they do it with a sort of a slightly dovish tilt, and I wouldn't want to over accentuate the word dovish, but if they do it with some conditionality, as I say, something softening on growth or something like that, then actually the market may take it okay.
Okay, that's interesting perspective then. Interesting to, absolutely flag that it depends how hawkish or dovish they are in the commentary that goes along with whatever hike they do deliver then, Chris. Let me ask you about a growth focus. What do you think we will hear from the Fed around the strength of the US economy? Because that's crucial in terms of the market's assessment of how many hikes the Fed thinks it will get done during this cycle.
Yeah, I mean, I think there's an argument that they might talk about the temperature being a bit cooler, certainly in terms of growth. So, we had ISM new orders again the other day. Over the last couple of months, they've softened pretty sharply. Housing's coming off its hottest temperature, if you like, and there's a bit of softness there in mortgage apps and things like that. So quite a few parts of the cyclical part of the economy are feeling the effects a little bit of higher rates already. So there's definitely an argument that they may dial down the discussion of the strength of the economy. Payrolls remain pretty good, but those other parts, as I say, payrolls a bit of a lagging indicator. Those other parts have seen some softness. So I think that's really a key area to watch tonight, what they say about the economy, the update on that, and any comments along those sort of lines.
What about the international influence here, Chris? I mean, clearly they set policy for the US market, but it is influenced by international factors. And I'm thinking about Chinese growth. I know that Bloomberg Economics have been asking whether weakness in Chinese growth might actually slow the pace of hikes from the Federal Reserve. They say it's too soon for that to actually happen, but it's something they're thinking about. Is that a connection that you think the Fed will increasingly have to look at as we go through this year?
Maybe as we go through this year. I don't think, personally, I think what we're seeing in China is an easing cycle, so we're going to get an acceleration of Chinese growth. And in that sense, it's in a completely different place to what you see in the US and other central banks in the West. But I'd be very surprised if they made even a hat tip towards the Chinese housing market tonight. I think it's all eyes on US growth and all eyes on the outlook for US inflation, and all eyes on how hawkish the Fed feels it needs to be and whether or not it feels it's done enough heavy lifting and jawboning of the market, which is really what it's been up to over the last few months. So yeah, I mean, China may feature later in the year, but unless it falls apart sharply from here, which, as I say, I don't think we expect, then I don't think China will be a main focus of tonight.
Chris, we're talking about a historic rate hike here, the first 50 basis point hike priced into the market since May of 2000, 22 years. But I have to ask, what is it going to take for the Federal Reserve to start easing again?
Great question. I mean, I wouldn't be surprised if we got a cut next year. That's not impossible. Now, that will come after a whole series of hikes this year and some quantitative tightening. I mean, the interesting thing is what we're doing is we're unwinding, firstly, funny money. We're moving back to what I would call normal monetary policy from easy. And then the question is whether you start to move towards tight. And certainly the pace we've seen from the Fed, the language we've seen from them, I think means that once we get towards the end of this year, there's going to be some pressure the other way for 2023. There could be some real challenges on growth. There could be some challenges in the way financial markets behave. There is a bubble in the US financial market. It's perfectly plausible that it's popped by expensive money later this year. Some would argue it's already popped. I'm not convinced that's the case, but there's definitely an argument that later this year that comes to pass. And therefore, 2023 could actually see a cut. So, we need money to get tight first, but then you could easily get to that stage where, as I say, next year, the Fed's actually looking the other way and moving the other way to try and offset some of the downdraft from financial markets deteriorating and from some softness in the economy.
So a potential cut in 2023, but then you add on European sanctions, an oil import ban of Russian oil. Calls that on Wall Street have really been made for as much as high as $200 oil on the back of that sanctions package. Does that prolong the 2023 cut in your view?
No, because I think the growth of money supply is already slowing dramatically. It's, if you look at M2 money supply growth, it was 25% or so last year. It's now down under 9%, 8-9%. It's slowed very sharply, and it's slowing sharply. That's the trajectory. And if that continues, what will happen is an oil price spike will be deflationary, not inflationary. Remember those days? Back in the old days, we used to say whenever oil price went up, it slowed the economy, it was deflationary. Now, because there's been so much money around in the last 2 years, it's been inflationary. But I think if you roll forwards, you'll find into 2023, it's back to the old deflationary style, because money supply growth is slowing. And if the Fed keeps doing what it's doing, it's going to continue to slow. So there's less money to go around, and that's the way oil price plays out. By the way, I'm not convinced oil goes to 200 anyway. I wouldn't be surprised. I realize there's a sanction risk, but I wouldn't be surprised if we'd already had the high in the oil price on March the 7th.
Interesting that we only, in inverted commas, got as far as 108 on Brent today on the back of the EU's oil announcement. Chris, thank you very much for joining us. Chris Watling, CEO and Chief Market Strategist at Longview Economics. Coming up, Wall Street crackdown. The Bill Hwang case is just the first in an upswing of federal investigations into a slew of suspected trading abuses. More from our Big Take story next. This is Bloomberg.
This is Bloomberg Surveillance Early Edition. You're looking live at the principal room. Coming up later today, NASDAQ CEO Adena Friedman. That's at 11:30 a.m. in New York, 4:30 p.m. in London. This is Bloomberg.
This is Bloomberg Surveillance Early Edition. I'm Kriti Gupta with Kailey Leinz in New York and Anna Edwards in London. Matt Miller is off today. That case of Bill Wong is the first in an upswing of federal investigations into a slew of suspected trading abuses. 3 other sprawling inquiries have emerged in recent months examining so-called block trades, short sales, and well-timed wagers. They all center on the same question: are the markets rigged? That's the topic of today's Big Take. Bloomberg's Sri Natarajan co-wrote the story and joins us now. Thank you for waking up early for us, Sri. Let's start off with this Bill Wong arrest. Is it surprising? Do we see more coming?
Well, we obviously knew that there was a big investigation going on into Bill Wong and Archegos over the last year because of the tremendous collapse of his family office. But we also know that over the last few months, his attorneys, even Bill Wong himself, had been cooperating with the SDNY, had been going in for interviews. And yet, all of a sudden, on the very day that his attorneys thought that they were having productive conversations with prosecutors, a sealed indictment was filed. 2 days later, he was arrested at the crack of dawn. That caught a lot of people by surprise. And the charges are also interesting. Racketeering charges, 11 felony charges, and possibly the rest of his life in prison.
Yeah.
That's caught everyone to pay attention.
Well, and of course, regulators and prosecutors are not just looking at him as an individual. There's also probes going on into block trades, things like short selling. I mean, this is a more holistic, all-encompassing view into things that haven't necessarily faced this level of scrutiny in the past.
It certainly feels like what people are calling the everything crackdown. Across the board, you're seeing the DOJ, the SEC, other regulators ramping up their scrutiny into corners of Wall Street that they didn't pay too much attention to in the past. Granted, these things are cyclical, they wax and wane, but during the Trump presidency, you did certainly feel that, relatively speaking, there was a more lax approach, and there's been a complete turnaround. They are making cases easier to start, faster to finish, and they want them to be more punishing to send a message to Wall Street.
Yeah, and Sri, good morning. Is there a sense then that this comes right from the top? I mean, you mentioned the previous administration. Do we get a sense that tackling white-collar crime is a real priority then for this administration?
No, absolutely. On the day that the Archegos charges were unsealed, you had the Deputy Attorney General of the United States, Lisa Monaco, at the press podium in Manhattan, commending investigators for how quickly they moved on it, and also making the point that these are exactly the type of cases that the DOJ should be going after. So it certainly feels that across the Biden administration, across the regulatory and enforcement land, there is a greater focus on everything Wall Street, on everything that people are complaining about. They want to be clear that they are presented as the folks who are going up against Wall Street.
Well, and of course, to that point, Gary Gensler certainly trying to crack the whip as well. Again, though, these are kind of, as we were talking about, gray areas, or at least they have been in the past. Is there a risk that regulators are going to make the rules as they go here, and you'll be punished in hindsight for things that didn't necessarily have punishments that go with it?
I mean, there's certainly an interesting concept known as rulemaking by enforcement, where you have what you think are regulatory gray areas, where traders thought that it is in the gray that they could operate. Prosecutors really want to bring cases where they make it clear that they need to be far away from that line. So that risk certainly exists, and that is something a lot of defense attorneys, all of Wall Street, the big banks, the buy-side firms, the hedge fund, private equity firms, everyone's going to be paying close attention to.
Sri, thanks very much. Bloomberg's Sri Natarajan with the latest on that Big Take story. Bill Wong's arrest sets the stage for Wall Street crackdown. More on the terminal. Now, coming up in the next hour of programming, an exclusive interview with JP Morgan CEO Jamie Dimon. That is at 6:30 a.m. in New York, 11:30 a.m. here in London. This is Bloomberg.
The risk of having a perfect storm where Europe is in recession because of the war, China's in recession because of a failed COVID lockdown policy, and the United States because the Fed tightens too much, too fast, or however we judge it in response to inflation. And those all feed on each other.
Harvard economics professor Ken Rogoff speaking yesterday on Bloomberg Surveillance with Jonathan Farrow, Lisa Abramowitz, and none other than Tom Keene, who will be also leading our Federal Reserve coverage today and is joining us now. Tom, what is your single best Fed Day chart?
The single best charts to get us ready for a 1 hour earlier Fed Day. We're going to start at 1 p.m. this afternoon. Kailey, the meeting is so important and really so historically inconsequential, as you heard from Professor Rogoff. Let's look at the great disinflation. This is a very familiar chart to global Wall Street, but always bears repeating, particularly on an historic day like this. Up from the 71, 50 years of the Fed rate up to the Volcker inflation. Down we go, the great moderation. We flatline. There's a little bit of recovery, and then it drifts away.
And you're going to be speaking to a perfect guest on this subject, the Nobel Prize winner in economics, Paul Romer, who I know operates at the juncture of economics and technology.
Yes.
Someone who can comment on that deflation, Tom, and also Jamie Dimon on the program, of course.
Well, Mr. Dimon will be with us, I believe, with Francine Lacqua. We're really looking forward to his comments here, particularly after his 40-some page annual letter. This is the morning show with the laureate, Paul Romer, and you're absolutely right, Anna. Paul Romer is about the technology we observe and maybe that we don't understand. And just as well, we go on to the Fed meeting and we start strong with Matthew Lazzetti of Deutsche Bank. And I can't say enough about their recession call.
All right, Tom Keene, co-anchor of Bloomberg Surveillance, thank you. Looking forward to the coverage over the next 3 hours and, of course, this afternoon for The Fed Decides. Now, of course, when we look at what we're watching today, I will be watching Tom, John, and Lisa talking about the Fed decision, but also, guys, the market reaction to it, because this is a market that has come so far in pricing an aggressive and hawkish Federal Reserve. The two-year yield is already up more than 200 basis points year to date, and it is only May 4th. So my question really is, what could constitute a hawkish surprise from the Federal Reserve today, considering we have an RBI that just came out and hiked rates, surprisingly, an RBA that hiked more than expected just in the last 48 hours? So could the Fed come out and do the same? But of course, we were talking to Chris Watling of Longview Economics earlier today, who said even a 75 basis point hike might be something that the market is able to digest depending on how the Fed does it. So really interesting to see how the market takes down not just the decision, but whatever Jerome Powell says at that press conference.
Yeah, interesting comments will be also what he says about the growth picture. We know decelerating growth is the dynamic here, but we also see it on the micro front, right? We see earnings as well. Lyft, for example, plunging this morning on that disappointing growth outlook, and something investors really aren't hesitating to punish those growthier stocks for. So what I'll be watching is those earnings for Uber, expected at 7 a.m. We know has been pushed up. It was supposed to be after the bell today. Instead, it is pre-market. I wonder what they have to say on the growth picture, Anna.
Yeah, absolutely. I wonder what they have to say on the growth picture. Also weighing into the growth picture is what we've heard on oil today from the Europeans. The European Union then sanctioning the Russian oil. How high does the oil price go on the back of that? That's crucial. We talked to Chris Watling about this as well from Longview Economics, and he was saying that perhaps we've even seen peak oil. We will look back on this day and ask ourselves whether that was true or not. But 108, up by 3.5%. At a time when we saw the Europeans ban Russian oil, or at least they say they're going to in the future, with a 6-month lag, and maybe, Kailey, that makes the difference. Because this inflation dynamic around commodities ties in very much to the Fed.
Absolutely, Anna, and we have to keep in mind, this is oil we're talking about for Europe, which is far less important than gas. Gas would be an entirely different conversation, I think.
Yeah, absolutely. A different subject altogether, one we may or may not be having in the future. That is it for the early edition. Surveillance is up next. Tom, John and Lisa will be taking you through the next few hours and taking you through the Fed Decides. This is Bloomberg.